and welcome to Indianomics. In every speech, the US president has threatened India with reciprocal tariffs. Even if it's a general interview, India finds mention. Now, how much higher can the tariffs go for Indian exports to the US? Which sectors are vulnerable? And what's the impact on India's macros? You know, on inflation, deflation, growth, current account deficit. Those are the other questions. And of course, what's the impact on Asia as a whole? Where do we stand in terms of comparative disadvantages? I have three experts to discuss all these questions. Samiran Chakraborty, the chief economist, India at Citi. Ajay Srivastava, the founder at Global Trade Research Initiative. He's a former civil servant and therefore knows a thing or two about the Commerce Ministry. And Chetan Ahya, chief Asia Economist and emerging markets specialist at Morgan Stanley. Chetan, Samiran, Ajay, Mr. Srivastava, thank you very much indeed for joining me. Well, Samiran, first the macro question. You know, how much should, what is our total exports to the US as a percentage of total India's exports and as a percentage of GDP? So what's at stake for the macro?
So our exports to US, the merchandise exports part has gone up quite substantially. So we are now exporting around $80 billion to US, and that's about 18% of India's total export. So from that perspective, it's quite substantial. The growth has also been quite good. And more importantly, what has happened is that our trade surplus with US has widened, almost doubled from around $25 billion to now, by US estimates, almost close to $45 billion. By our estimate, the number is more closer to $38 billion.
Okay, so that's a substantial amount of money. But as a percentage of India's GDP, assuming a lot of this is impacted, how much would the, as a percentage of GDP, the exports be?
So by India's GDP, it's only about 2% of GDP, because India, as we know, is more a domestic-focused economy, not as much an export-oriented economy. So from that perspective, when you put it in a scale of how other countries are susceptible to these risks, India will probably stand at a lower end.
Okay. Chetan, your report shows that relative to other Asian countries, India is more vulnerable because we tariff the US imports much more than other countries?
Yeah, I think that the three factors that we are looking at when we are assessing the exposure to tariff risk. Number one, the trade surplus that India runs with the US. Number two, the tariff level, tariff rates, how high they are. Also, we are looking at now GST, because in the press release that the US administration released for reciprocal tariff discussion, they mentioned about VAT in different countries also being higher compared to the US. US does not have any VAT. So when you consider tariff rates, the fact that India has GST, which US does not have, and then the third thing that they are looking at is non-tariff barriers. So when you consider all the three factors, we think India will find it difficult relative to this whole reciprocal tariff issue that the US has raised. The other two countries which are in focus is Vietnam, and to some extent, not two countries, but three countries, to some extent Korea and Taiwan. Taiwanese economy will also be facing some challenge related to this reciprocal tariff stuff.
Samiran, you have done the math. What should we consider as susceptible in terms of sectors?
So there are two different parameters on which you have to judge this. One is for which sectors the tariff differential is the highest. And second is that among those sectors, which are the ones which export more to US. So if you do this screening exercise on the sectors, what turns out is that sectors like chemicals, sectors like James and jewelry, some of them, and to some extent now even transport, they are the ones where the impact could be a bit more. But the big challenge for all of us is that We don't know whether these reciprocal tariffs are being considered for across the sector or it's going to be more product wise. Also, as Chetan mentioned, how much of the VAT type of discussion will come into play, to what extent the non-ad valorem tariffs, where India charges less non-ad valorem tariffs compared to US, that will come into play. And last but not the least, how we will incorporate the non-tariff barriers, the quality control orders, etc., into all these negotiations. So at this point, it's very tough to say exactly which are the sectors which will be differentiated and will be impacted more. But the ones that I mentioned in our screening exercise, they come out at the top.
Okay. Ajay, I guess we finally have you. Can you tell us, according to you, which sectors you would worry about?
Latha, before that, I want to tell even Trump administration is not clear how they are going to exercise all these things. Are they going to impose at the country level? Then the impact will be different. Are they going to give one tariff on industry, another for agriculture? Then it will be different. Are they going at the sectoral level? They don't know any of these things because only two sources of information are there, two whiteout notes and one fact sheet issued on 13th February. It is not clear. So, for example, they take the example of Harley Davidson and for the industrial products, and for agriculture products they say entire agriculture sector. So we don't know. Only when they start talking in detail we'll come to know. But I have done an exercise at all the levels. What will the impact? So impact will be different. As I said, if they want to punish India, I mean all the products with the one tariff, then we must know that tariffs are being talked at a very higher level. The real tariffs being faced by the US goods, weighted average tariffs are not that high. So we have done exercise. So at the country level, the average weighted average tariffs faced by the US goods in India is only 7.7%. This includes agriculture and industrial products both. And Indian products, in contrast, face only 2.8% in US. So tariff gap or differential is 4.9%. We say, okay, so US has a case for imposing 4.9% additional tariffs on Indian exports. That's number one. Now, if they want to talk about agriculture separately, as they talked in, say, fact sheet, then, of course, the US goods, they face 37.7% tariffs in India. Indian goods face 5.3% tariffs. So tariff differential looks like high at 32.3%, but most of the US agriculture imports are at the non-ad valorem tariffs, which means 30 cents per kg or 10%, whichever is higher. These are complicated and real impact will be much more. Oh. So India needs to factor this while negotiating the US. Okay. Their tariffs may be actually much higher level.
Okay. Sure. Chetan, do you think that we are discussing very prematurely? If clearly your numbers are different from Ajay Srivastava's numbers, and even to some extent Samiran's numbers. If you, I think Mr. Srivastava's numbers don't factor in GST. If we did that, then the differential would be higher. Is that right, Chetan? Is that why there is so much of a difference depending on which source I'm quoting?
No, we have all the various options in the note that we have published today. We have looked at just the weighted average tariff. We have looked at simple average tariff. We have just added an additional analysis related to VAT, which is in India's context, it's GST. But you're right that we don't know, and as Ajay was mentioning, it's unclear what metric they are going to use to discuss this thing with India. But I think the simple message is as simple that India's tariff rates are high relative to other trade partners. And all what the US is sort of effectively raising is that you have to address this. And what India is saying is that, yes, we can do it, but we cannot arbitrarily reduce it for just the US. We have to do a trade agreement. Otherwise, it will not be WTO compliant, but also the fact that, Euro area will come and say, hey, you are reducing it for US. Why not you reduce it for us? And so India has to do it under a trade agreement. And that process will be taking time. Just, I think yesterday or day before yesterday, Commerce Minister was saying that it will be probably done by fall of 2025, the trade agreement between US and India. And what we are highlighting in the note that we published today is that President Trump has put a timeline of April 2 for reciprocal tariffs. And the trade agreement will take time, so it will probably be the fall of 2025. And so what happens on April 2? There is a risk that tariffs on India may go up. What is the metric that they're going to use and how much tariff they will impose is still not known, but there is a risk that there will be a rise in tariff on India before the trade agreement can be signed.
Okay. Oh, well, yeah, so April 2nd becomes important. Actually, my other problem with President Trump's announcements is everything is deferred. Other than the 10% on China, the 25% on Canada and Mexico, we will know on first week of March only whether they come into effect. The steel and aluminium 25%, we will know only on March 12th whether they will come into effect or whether that is again a threat and that will be pushed forward for whatever reason. And then we will know, of course, on April 2nd. So the next 40 days become crucial. But Mr. Srivastava, since you've been in the Commerce Ministry and you know how government works, is it practically possible for the US to have so many customs officers that, cashews that come from India, this is the tax. Cashews that come from the Middle East, this is the tax. I mean, this looks like a nightmare for any commerce department or customs department to implement. And then you have the DOGE. I don't know whether you call it doggy or dodgy, but they want you to reduce the number of people. So what is your sense? Do you think it will be product by product? Or do you think it will be, country by country? What will they do, you think? What is the most likely scenario?
So, Latha, I don't think it will be much of a nightmare for the customs officers because now software will tell what duty from what country is applicable, but it will be a bigger nightmare for the people buying from it. They buy based on the best value they obtain. Now they have to forgo about the best value and they have to add tariffs to that. So they may not be getting the best products at the best value. Now they have to factor the tariffs, and tariffs keep on changing based on the negotiations. So there will be no long-term negotiations. It will be detrimental to the global trade. I mean, since he's talking about tariffs on all things, there will be massive restretching of the supply chains.
Okay, now, I have to take my first break, but I want a monosyllabic or a single sentence answer from all of you. For a stock market audience, what kind of sectors should they worry about at all? Samiran?
I would say it's chemicals, transport, and to some extent, gems and jewelry.
Okay. Mr. Srivastava?
Chemicals, pharmaceutical, jewelry, electronics, and automobiles.
Okay. Chetan?
I'm just mentioning about the top high sectors, the sectors which have high tariff rates for the US, which is basically agricultural products, chemicals, pharmaceuticals.
Okay, got that. So chemicals, pharmaceuticals, agri-exporters also perhaps, and transportation exporters should worry. But what about the macros? What's the impact on the current account deficit? What's the impact on India's growth and investment because of this uncertainty? All those questions after the break to my guests. Welcome back to Indianomics. We are in conversation with Samiran Chakraborty of Citi, Chetan Ahya of Morgan Stanley, and Mr. Ajay Srivastava, the founder of Global Trade Research Initiative, on how the threatened President Trump tariffs may impact India and which parts of India. Chetan, Mr. Srivastava, and Samiran, thank you very much for your patience. Chetan, I want to ask you, as a person who's looking at the entire continent, the Asian continent, do you think they will go as the US administration will go that granular, product-wise, country-wise? Or is it more likely to be, okay, China 10%, India another 8%, Vietnam is in a surplus, probably Thailand and Korea another 4%. Is it more likely to be in that way?
I think there is a high possibility that it is that way. Like if you just recall what happened in 2018-19 with China, they did go sector by sector. So I think for the countries where they have significant size of imports, which includes India, I would say, $80 billion is not a small number. I think they may go at least focus in on a few sectors. Maybe there is like a groups of sectors, so you don't go hundreds of sectors, but you can sort of have some high-level groups like four or five groups, which could be lumped into one category. But there could be differential tariffs. If that's your question, then yeah, the answer is that there could be differential tariffs on different segments.
Okay, so different tariffs for different countries, and within countries, different tariffs for different sectors. That perhaps is the upshot you're looking at, right?
That's right.
Okay, Mr. Srivastava, what's your sense? I would still think, as you point out, for a buyer, it is chaotic because you don't know whether you're getting, how do you get from the cheapest source? It'll be very difficult, and there will always be country hopping. I mean, if I'm charged a lot for textiles out of India, I could clearly sell it to a trading company in Dubai, which reroutes it by mixing it with, other textiles. So these can be sidestepped. What, according to you, a government would do if you were in their shoes, from the US point of view?
US government?
Yes. How would they tax us? Would they say all aluminium, all steel, all textiles, all agriculture, irrespective of country? Or will it be country-wise? Or as Chetan says, both country-wise and sector-wise?
Latha, they have to first update their database. In that fact sheet, White House fact sheet, they mentioned that India charges 100% tariffs on Harley Davidson. It is 30% now. Okay, so 70% gap is there. Mr. Trump on 13th February, with our Prime Minister's meeting, he said our deficit is $100 billion. It's $42 billion. So they are wrong on a big data. I don't think they will be risking going at the product level or even at the subsector level. They may be going at the industry level or the agriculture level so that they cannot be challenged. Of course, they will be challenged. But if they go at a finer level, the risk for challenges proving them wrong will be increasing. And I think their basic data set needs a lot of revisions.
Okay. So your best guess is that nothing much happens on April 2nd, Mr. Srivastava?
No, they will be announcing maybe one particular set of tariffs for agriculture, one for entire industry, maybe.
Okay, that's the more likely outcome. Okay, yes. In which case perhaps we may not be. Exactly, that question to you, Samiran. Assuming that there is more of a macro tariff, what is the impact on, say, our current account deficit or on our export performance?
So we're all working with slightly different numbers, but our sense is that the current tariff gap is about 8% or so. And then you are on a bit of a guesswork on how much of these tariff increases, hypothetically, would be passed on as higher prices. Because there is always a possibility that companies absorb some of these tariff increases and actually the prices don't go up that much. But assuming full pass-through of these tariff increases, that this entire 8% increase gets translated into 8% higher prices, and then assuming some price elasticity of export estimates that we have from the past. Again, it's very obvious that not all sectors will have exactly the same price elasticity, so we are making sweeping assumptions here. But if you do that, then probably you end up with something like a $7 billion impact on our exports coming out of the tariffs being equalized at a very top level.
Oh, that's what 1% of our total exports. I mean, that's not going to hurt, right?
Yeah, I mean, there are different ways to look at it. It's also possible that some of this exports gets channelized to other countries, especially if there are differential tariffs in different countries. Then in some sectors, India could benefit as well. So this is such a big general equilibrium problem that it's very difficult to do this ceteris paribus analysis that just one tariff rate change and we can estimate what the impact would be. So I'm putting this as a very tentative estimate and not really something which we can hang on.
I sympathize entirely. We are dealing in very, very speculative assumptions. But Chetan, a more fundamental problem. The US president wants current account surplus with all countries. Now, if that were to happen, they will not print dollars. After all, why is dollar the reserve currency? Because they meet their deficit by printing dollars. If that happens, that he runs a surplus, then the dollar will be in short supply. do you agree with that theory, that the Triffin's paradox? And if that is the case, at some point they will have to give up on one of the goals, right? At what point will that be? 1 year down the line, 2 years down the line?
Yeah, Latha, I'll answer that question, but I wanted to answer the question that you had asked Samiran briefly as well. So, look, I think the implication of these developments will have to be seen first in the context of what is the direct effect of tariff on growth. And second is what is the indirect effect of tariff on growth, because tariffs are going to affect global corporate confidence, global capex, and therefore global growth. So my experience of 2018-19 tells me that the direct effect of tariff tends to be manageable. But it's the indirect effect of what tariffs do to global corporate confidence, global capex, and therefore India's exports and Asia's exports is going to be more important. And at this point of time, it looks like corporate confidence is not getting dented. But if you could persist with this approach of levying tariffs every day on different sector, different country, then at some point of time, that's the risk to be watched. And I would be worried about India's growth more if you do see a broad-based global trade slowdown rather than just the direct effect of tariffs on India. Then going back to your second question, rather the first question to me.
Yeah.
Look, I think it's a complex situation. There is also a capital flow into the U.S., which is there because the U.S. growth story is strong. So it's a reserve currency. You don't need to have your balance of payment being balanced. So I'm not worried that much about the reserve currency status being addressed or threatened because of current account movement. But in any case, we'll have to see whether U.S. current account deficit actually narrows because of all the effort that the tariffs are taking up. Because if you look at 2018-19, U.S. trade deficit overall was around 4% of GDP. And that is exactly where we are, despite whatever tariffs were imposed in 2018-19. So tariffs are not necessarily going to fix that trade deficit that U.S. runs. And in my report today, I'm highlighting ultimately, the other way to look at current account balance is saving minus investment. And so what U.S. is doing is running its saving rate relatively lower than its investment, and that's why it's running current account deficit. So if it does want to fix it, then you also have to improve your saving balance.
And you may also impact your growth if you start exporting your savings. So those macro considerations also come into play. But as you say, at the end of the previous round of tariff hikes, the US current account deficit did not change at all. So perhaps we are discussing this a bit too early. Perhaps we are worrying a bit too early. We will come back to you on March 12th, on April 2nd, to check back how much the US government is actually imposing tariffs, or whether the can gets kicked further forward because you're negotiating with all these countries. On that tentative note, Samiran, Mr. Srivastava and Chetan, thank you very much indeed for informing us on all the things that we should worry about and should not on the US-India tariff issue. Thank you for watching this edition of Indian Optics.